Again, welcome everyone. Let's just take a second here to review the agenda. So we're going to focus on some of the background of why there's a need for best practices in the down payment ecosystem. We're going to hear from some industry partners on the benefit of having best practices. And then we're going to spend some time reviewing the best practices themselves. Roxanne from the city of Minneapolis is going to lead that. And then finally, we'll talk a little bit about adoption and endorsement as well as next steps. We built in lots of time for questions and discussions, but please feel free to drop questions in the chat as we go. And we're kind of going to focus in the beginning more on presentation and you kind of listening, but then again, towards the end, we'll have lots of times for conversation and questions. And then before I move on, I just want to take a quick second to introduce some of the other people who will be presenting today and participated on developing these best practices. We have Lisa Ekstrom from US Bank, Roxanne Kimball and Ryan Nestigan from the city of Minneapolis, and Megan Seeger from Three Rivers. So thank you guys all for joining and participating today, and we'll hear from you shortly. So just again, spending a little time providing some context and background as to how we arrived here. So in 2020, the Minnesota Homeownership Center, in partnership with the Minnesota Realtors Association, commissioned a study on the potential impact of down payment assistance for our market, as well as held listening sessions with industry partners. The goal is we really wanted to better understand how down payment assistance could support our mission, the center's mission of advancing successful homeownership for those who face the greatest barriers. Both the report and the listening session confirmed what many know to be true. While there are many barriers to home ownership, the lack of capital for down payment is the most significant financial barrier for first-time homebuyers, and even more so for first-generation buyers who do not have access to intergenerational wealth. The report was based on 2018 numbers and estimated that approximately 35% of Minnesota renters could purchase a home if they had access to down payment assistance. Further, it estimated that more than half of those could purchase a home with approximately $10,000 in down payment assistance. Now, many of us know that the home prices have, I think the median home price has probably increased by almost $100,000 since 2018. So when you look at today's numbers, that amount is much closer to $15,000 or $20,000. And for many households, it's even greater because of the lack of access to generational wealth and the income disparities. Through the report and the listening session, we also learned that down payment assistance, while super beneficial, is often in our market not well known or understood, and is often challenging to navigate for consumers, lenders, real estate agents, professionals alike, and that the need for down payment assistance often outstrips its availability in what's in the market to be offered. So as a result of those learnings, in the summer of 2021, we established a cross-sector working group with the goal of improving the down payment ecosystem and increasing funding. The working group has about 20 members and includes lenders, county and city municipality staff, as well as many nonprofits, down payment funders, and other nonprofits doing work in the community. So again, while the report demonstrated the need and opportunity for down payment assistance to advance homeownership, it also clearly identified many challenges with the current system. So for both consumers and industry professionals, the system is fragmented and often creates confusion. Many consumers are not aware of the programs, and the complex nature of them often discourages their use unless they have the support of a professional who's really willing to go that extra mile and help them make it happen. With more than 50 programs available statewide, there's minimal to no standardization. And beyond these kind of challenges with the system, it's very clear that we need more funding, both collectively to reach consumers and specifically to increase the amount of assistance being provided to consumers to account for increasing home prices, stagnant incomes, and again, the lack of access to generational wealth. So understanding the challenges, it became pretty clear to the working group that a really important first step toward the goal of improving the ecosystem and increasing funding is we really needed to begin with standardization and outlining some best practices. We believe this will in turn help us remove barriers that are now preventing consumers from accessing DPA, enable more successful transactions, and increase the investment in DPA. Having established best practices also can create a pathway for new DPA providers to help them legitimize the need, as well as with current DPA providers to really push for an increased investment to show really what is the standard approach to making DPA work. Beyond those, we believe that standardization will also help ensure that down payment is reaching those with the greatest need and those who, without the assistance, would not be able to access homeownership. And finally, we view the best practices as a starting point, a foundation really for building coalition among providers statewide. And we recognize that this is the beginning, but as we come together as a coalition, that there's going to be a real opportunity to make sure that DPA works for the consumer and makes the impact we want it to. So now we're going to take a moment to hear the perspective of a lender, funder, and DPA provider. We're going to start with Lisa Ekstrom, and then we'll hear from Ryan Nestigan, and then finally Megan Seeger. So Lisa, I'm going to go ahead and turn it over to you.
Wonderful. Thanks, Brooke. Hi, everybody, and I'm glad to see all of you. You know, I've been in the industry for a long time, so a lot of you probably know me and vice versa. So like Brooke said, I'm with US Bank Home Mortgage and I'm the community product manager there. So one of my responsibilities is to review and approve all of these DPAs, not only in Minnesota, but across the nation. So really selfishly, I'm hoping that this is a huge success in Minnesota and we can spread it into other states to make my life easier. So, you know, there are, as Brooke kind of touched on, a lot of difficulty in reviewing a large variety of DPA programs. You know, more so that seeing them nationwide, but when I am getting these in on a regular basis and they are all structured differently, the note and mortgages are different, there's different parameters, etc. It just makes it a longer process to review and approve these programs. And actually today I just had a perfect example that I can use for this group. This morning I received, well, let me back up. In a perfect world, we would love for our loan officers to know about these programs in advance, compile the information that I require to review and approve them and send them to me so I can review and approve them, get them on our approved list so we're ready to go and able to use them. We all know that doesn't usually happen. Oftentimes the loan officer will hear about these programs when they've got a loan in the pipeline and, oh, by the way, they're closing next week and you need to hurry up and review and approve this program. And gee, that happened to me this morning. We have one loan in the pipeline for a DPA program that the loan officer didn't realize the borrowers were getting. It hasn't been reviewed, it's not on our list, and the borrowers are closing next week. Of course, I'm not going to say, no, your LMI first-time homebuyer borrower isn't going to be able to use this because you didn't follow the proper procedures we have internally. But boy, if I could see that little certification or know that this has gone through that best practices and is following that, that would make that so much faster and smoother, which kind of leads into, you know, the best practices standards. It just would make it easier, again, on a selfish note, for lenders to be able to take a look at these programs, know they're following those best practices, and be able to offer so many more of them, because there aren't, you know, if there's little glitches or things that I haven't seen before, then I need to send it through legal or maybe reach out to Fannie or Freddie, you know, the investors, to see if it's something they'll allow. It just will make it much easier. The lenders will know what to expect. And it just will give, enabling lenders to be able to offer these programs on a wider basis will definitely help your borrowers be able to have so many more options of different lenders they can go to, different programs that we can tie them with. Again, because when I review those programs, because they're also individualized, I, have to go through, does it meet Fannie's guidelines? Does it meet FHA guidelines? Does it meet, can we tie it with Minnesota housing perhaps, or our own internal portfolio CRA product? So just, that was a really quick overview, and I know we're going to have time for questions at the end, but really wanted to emphasize from a lending perspective how we love these programs, want to work with them, but the easier and more streamlined that they can be made, the more we'd be able to offer them to your borrowers. And Brooke, I'll turn it back over to you.
Thanks, Lisa. I really appreciate that perspective. All right, Ryan.
Hello, everyone. I've crossed paths with some of you through interaction through my work with the city, but essentially the city kind of, our part of the best practices was providing administrator and a funder perspective in relation to how the city has provided down payment assistance. In the sense of how we provide the assistance and communicate it to prospective home buyers in our city. Personally, I think it was beneficial to be part of this group that had people from different cities, counties, and organizations help kind of facilitate the best practices that you will see later in this presentation. And what I took away from it was the benefit of these best practices has been that it influenced our pending changes to our down payment assistance program that help us make changes, specifically simplifying the process for home buyers, mortgage lenders, and realtors, with aligning our procedures and practices so all that we work with knows what to expect from us. So back to you, Brooke.
Thanks, Ryan. And last but not least, Megan, who's from Three Rivers and actually operates and administers DPA.
I administer the DPA program at Three Rivers. Like Brooke said, we're a nonprofit community action based out of Zumbrota, Minnesota. In the last 10 years, we've helped about 150 buyers purchase their homes with the goal of closing the home ownership gap in Minnesota, like the racial gap between home ownership rates. I think we might be one of the smaller programs on the call since we only serve about 15 households a year. We do cover 20 counties of Southeast Minnesota. So we've started implementing a few of the best practices, but one of our challenges is that there's not a lot of sources of flexible funds in our region. We work with local funders when we can, but we're relying on statewide programs and having our buyers layer with as many first mortgage options as possible, like MHFA startup with their down payment, and rural development, single family direct loans that can go up to about 100% loan to value, so that our funds stretch farther, because like Brooke was saying, these days you need a little bit more than maybe 20,000 of down payment and closing cost assistance. So overall, we do have a great partnership with our funders, but working within the limitations of their program compliance could be a challenge for us with the best practices. Implementing the best practices would help us, though, a lot with our clients. We can meet them where they're at better. One example would be opening our program to ITIN. And then also with all the fund layering, if it was like a statewide best practices, that would be much easier for our clients and their lenders to layer funds. We have a larger Achieve Homeownership program, serves a lot more than 15 households a year, and something I've heard from our advisors and outreach staff who do the counseling and education is that these best practices would give our buyers more confidence when they're home shopping and making offers. Home buying can be risky, it can be a vulnerable process, and a lot of our clients are just not familiar with the US banking system to begin with. So maybe having like fund reservations and stuff like that would help them, give them the confidence they need to actually make that offer and hopefully receive it. And then by helping them reach their goals of homeownership, our homeownership programs can meet our targets as well.
Great. Thank you, Megan. I appreciate that. Okay. Thank you guys all for sharing your perspective and again, just your involvement on this overall. So each of the organizations shown on this slide participated in the development of the best practices and acted as subject matter experts. There were many meetings over about an 18-month period. And we started by reviewing kind of current practices of what we see happening in the market and discussed how we might improve them for the consumer. Continuously throughout this process, we return to the question, what is in the best interest of the consumer? Beyond the subject matter experts who were involved in the committee, we also sought input from other down payment funders and administrators throughout the state. And all of us understand that this is likely, if not guaranteed, that these best practices will evolve over time. This is a starting point. And there was actually areas where we wanted to even be more prescriptive, but realize that we have to start at a common ground. And then as we build coalition and movement moving forward, that there'll be an opportunity to even refine these to better meet the interest of the consumers. So before I turn it over to Roxanne Kimball at the City of Minneapolis to give an overview of the best practices, I want to explain a bit about how the document is organized. So there are 3 columns. The first column is the term. The second column is the standards, which are the must-haves or requirements for a down payment program to meet the best practices. And the third column, when applicable, is advancing racial equity. So while this is optional, we strongly encourage those committed to reducing the racial homeownership gap to consider these practices that are outlined under the column Advancing Racial Equity. For our conversation today, we are going to focus on the standards. And as we get to kind of next steps later in the presentation, we'll talk a little bit about future topics and different areas that we'll be covering, which we do have a future goal of having a more in-depth conversation around how DPA can help advance racial equity. So with that, I'm going to turn it over to Roxanne.
Thanks a lot, Brooke. Hi, everyone. I'm Roxanne Young-Kimball with the City of Minneapolis, and I'll do my best to give an overview of the best practices. And as we walk through, I'll also try to provide some context of what the rationale was from the working group. So first, to ensure that assistance reaches the households that are actually experiencing barriers to homeownership, we recommend restricting DPA programs to first-time homebuyers. At minimum, meeting the federal home program that has a first-time homebuyer definition. It's in 24 CFR 92.2, and it also aligns with both Minnesota Housing and Freddie Mac's definition of a first-time homebuyer. Basically, you can't have owned a home in 3 years, and it also includes single parents or displaced homemakers who owned a home through a previous marriage. You can elect to have a more simple definition, such as having never owned a home or lost a home due to foreclosure, but we wanted to be clear about what the minimum standard should be. Next, we also wanted to call out setting an income limit that is at or below 100% of area median income. If you're using CDBG or home funds, you may be required to use a lower area median income. But in general, we're trying to ensure that the down payment assistance resources that are so limited are targeted to the people who, but for the down payment assistance, wouldn't be able to purchase a home. And a note on the racial equity component of this, I highly recommend looking at the median income disaggregated by race in your community and considering from there. And I'll give an example of Minneapolis and how doing that work informed us. The 11 county metro median income when we did a study in 2018 was $100,000. In the city of Minneapolis, it's $60,000, which is about 60% of area median income. And for Minneapolis Black households who have the highest disparities in home ownership, the median income was more like $25,000. looking at that difference in numbers really led us to change our homeownership program so that we focus between 30 to 80% AMI, because we want to have a clear pathway for Black homeownership as a critical value. And then next, we also want to ensure the amount of assistance provided is meaningful. So at least 3% of the county median home price. And that's closely aligned with the 3.5% down payment requirement for FHA loans. In Minneapolis, we've offered a $10,000 DPA program since 2015, just to give a sense of some local context. The median home value in Hennepin County in 2015 was $230,000. So our DPA was about 4.3% of the value of homes. Median home value now is $345,000. So we're at 2.8% of value. And I expect that that number is going to keep going up over time. So we plan to implement this county median home price change by having our council approve the percentage and then delegate authority to our staff to make the adjustments on an annual basis. That way our program can change and shift along with the market, and we won't have to go back to our council every time that there's a change in the market. Next slide, please. When you design your program, consider how to build a sustainable program. Forgivable loan has the greatest opportunity to build wealth for homebuyers and also limits the number of homebuyers you can serve because there's no opportunity to recycle the funds over time. That type of structure is best if you have an annual allocation that's going to grow over time. So for example, if you have down payment assistance from a percent of property taxes or a percent of permitting fees, or you know that you have an annual allocation of money that's coming from HUD, then a forgivable loan product is a really great fit. A deferred 0% interest loan that's payable from the net sale proceeds of a property sale opens up an opportunity to recycle funds to support future home buyers. For example, through a revolving loan program that's funded with local funds, CDBG, or home, you can recycle the repayments to serve future home buyers and have a more sustainable program. And then the third option is an amortizing loan. And it's important for an amortizing loan to be a second lien that has an interest rate that's equal to or less than the first mortgage and a term that's equal to or less than the first mortgage. Amortizing loan opens up the opportunity for serving even more future home buyers and keeping pace with rapidly appreciating markets, but it does limit home buyer equity gains from ownership, and it also can be a challenge in a depreciating market. We've used all three of these DPA types in Minneapolis. Our current proposal is a basic down payment assistance program that's deferred and revolves, and then a first generation homebuyer program that we're going to structure as forgivable. Next, we recommend that DPA programs center homeowner choice. Key components of centering homeowner choice include keeping the borrower contribution requirements small so that homebuyers have a safety net during their first year of ownership, ensuring broad access to different types of homeownership opportunities, including in dense developments like townhomes or duplexes or triplexes, or shared equity models with more affordable sale prices. And then also allowing layering between DPA programs so that buyers can access the assistance needed in a high cost market. Next slide, please. And connected to a high cost market, particularly in the current homeownership market, we also recommend a fund reservation model. Realtors, mortgage providers, down payment assistance providers are all telling us that homebuyers are using home buyers that are currently using DPA products are viewed as having weak offers in the market because the funds aren't guaranteed to be there. And our response to that is adopting a fund reservation, which means issuing a pre-approval letter with a time frame and giving a buyer time to shop for a home with options to extend that time frame over time. And then next. And finally, consider the administration needs for your program. If your funding model can permit paying the administration cost without charging it to the homebuyer, that's best practice. We recognize that some DPA providers may need to charge the homebuyer as part of providing their DPA assistance. If that's necessary, then ensure it's disclosed, that it's a flat fee, and that it doesn't exceed 3% of the assistance. Our goal is sustainable homeownership, and so ensure that your servicer has policies that allow the borrower to resubordinate if they're refinancing, especially for a lower interest rate, and provide options for cash out in order to facilitate home improvement. And then finally, we recommend requiring homebuyer education before the borrower executes a purchase agreement. The purpose of homebuyer education is to ensure that borrowers are aware of all of the options and pitfalls of homeownership. And we also want to connect down payment assistance to the buyers that need the funds the most. And requiring homebuyer education before a purchase agreement is issued is the key way that we're recommending to make that connection. And I think that's my last slide.
Thank you, Roxanne. So we're going to pause here. We have a couple of more slides that we'll review to kind of close out the meeting and talk about next steps. But we are going to pause here, and I'm going to stop sharing my screen so that we can see everyone. And it would be great if people would be willing to pop on camera for this portion of the conversation. But really, at this point, we kind of want to open it up. I mean, this is really about starting to share this information and hearing from you and answering any questions, or just hearing kind of your immediate thoughts and reactions would be great too. And then I'll just say, I'll ask Rachel, did we have anything that popped up in the chat during the meeting that we want to start with?
No, just a comment from Henry in the chat. Correct on all day long. We're submitting field. I'm not sure. Just a comment there, but yeah, no questions yet.
Okay, great. So then let's just open it up. So if people have questions, and maybe we can start with Henry, you can share your comment. And then as other people have comments and questions, I just welcome you to just go ahead and unmute or raise your virtual hand.
Well, my comment was about what Roxanne said about the belief that there are a lot of listing agents that believe if a buyer is using down payment assistance that their offer is not strong, they have bad credit, or if you're using FHA financing, that there must be something wrong with them. And as we teach in Homestretch, and as we just teach CE classes to real estate agents, for those that don't know, again, if you can use someone else's money to create an asset, that's what we've all been taught to do. But unfortunately, as more people of color use down payment assistance, and FHA is widely used by the Latino community and the Black community, it's a negative spin on it. So we need to figure out ways to change how people view down payment assistance. I really believe there needs to be some type of strong marketing campaign about it. There needs to be some more education around educating the larger box brokers, because they hold a lot of the listings, but they don't make up the majority of the associations. But it's just really about, there's a true myth that if you use down payment assistance, you are poor, you're lack of income, or you have bad credit, and that's something that needs to be changed. To help more people of color receive, to get their offers accepted. I mean, that's something we teach about, just name recognition and down payment recognition, that people automatically assume there must be something wrong with that buyer.
Thank you for that. Other people's questions, Ms.
I
Portia?
just want to say it was awesome, Roxanne, what you just presented. I'm so happy that the program that I manage actually has most of those components in it already. So we're already on board with what we're supposed to be doing and how to close that racial homeownership gap. I did have one question about the forgivable part. I don't know if the details have all been worked out, but what do you see as far as the length of time it takes to forgive, or is it just does it match the first mortgage, or is that something that you've ironed out yet?
So I think for the best practices, we decided to not weigh in on that, and essentially just kind of laid out, here's the 3 ways that you could structure repayment. I will say that programs that have been focused on closing the home ownership gap or building equity, we've seen 3 to 5 years, and others less. So that's one of those things that we were kind of like, let's not comment on that, and let's see kind of how it goes, starting with some of these initial conversations. But great question, Portia. And yay, I love that to hear that your program pretty much essentially meets these best practices. That's super exciting. Stephanie.
Hi, first of all, I was going to make a comment, and Aaron beat me to it, that there was a big movement to get the down payment assistance language removed from purchase agreements because it was discriminatory, and that has been adopted. So I think that obstacle, hopefully moving forward, will be eliminated. I totally applaud having some sort of streamlined system, but I just want there to be an understanding of flexibility. I suppose this is for Lisa, there are community differences. So like ours does not require first-time purchasers. It can be second, third, fourth, fifth, eighth time homeowners. We do have a first generation forgivable component on top of it. And ours is up to $60,000, but it is due to our community is unique. And so I want us to, I want to, be a team player, but I don't want to add restrictions that limit our program when I don't want to limit it.
Great. Thank you for that, Stephanie. Becca.
Yeah, hi. Thanks for having us all today. Megan, my question was for you when you were sharing. I think I had some commotion on my end when you were talking, but I think that you had said something about homeowners with an ITIN instead of a social security number, but then I didn't see that show up anywhere in the standards. And so wondered if you could kind of repeat what you said, and then if others wanted to talk about if there were conversations around if folks could have ITINs to be eligible.
Yeah, that is one of the standards, and we may not have shown it specifically, but it is on the full document. But yeah, we do recommend that it is open to those who have ITINs. I don't know, Megan, do you want to add anything to that?
Yeah, I mean, right now our program's not able to, just with our funding restrictions, but it's something that we're very interested in, hopefully expanding in the future.
Right.
And I'll share in Minneapolis, we specifically fund our program both with CDBG and with local funds. And we use the local funds whenever there's someone that has a need for an ITIN mortgage. We also learned from our administrators that it's really important to specifically call out that your product is something that can work with an ITIN mortgage. We assumed, since we didn't say that it was prohibited, that everyone just knew that that was something that was acceptable, and we were educated, if you will.
Great discussion. Marnie.
This might be a very basic question, but this question is for Lisa. So I work for the city of St. Louis Park. We have 2 different down payment assistance programs. I know that, like, for one of our loans, and we work with CEE, the Center for Energy and Environment. They're the actual lender for our program. But when you're talking about having DPA programs that are approved so that it streamlines the process when you're looking at funding, is that something that like CEE would be doing, like, going out to mortgage companies and saying, here's the program guidelines? Or, I mean, is this like a, every time a new loan comes in, it's being done. I feel like there was one time where one of the mortgage companies, asked we had to like send a letter like every 3 years that we meet the qualifications or something. So just kind of curious a little bit more how we can, I mean, there's a lot of lenders out there. And I think on our part, we can certainly work with, we do a realtor forum every few years, and we can try and like really promote that, we want to utilize these DPA programs in our community, but what, if anything, should we be doing to make sure that it isn't a barrier for people when it gets to that?
That's a great question. So the way we do it, I'm off of mute, right? Yeah, I wanted to make sure I unmuted myself. The way that we do it at US Bank is I review them once and add them to our list, and then they're on the list and they're good for every loan that comes in. Now, if you were to, a couple different things, one thing that I get hung up on a little bit is if you were to change your program and some of the parameters, and one of our loan officers who might work with your program doesn't find that out and know to get the updated information and send it to me just so I can update our approval, then some of the information I might have on our approved list is stale or old. But that doesn't disqualify it by any means. It's just our underwriters, when they see a file coming in from City of St. Louis Park and they look on our list, yep, it's approved, here's the max amount they can get, etc. Well, then your approval letter says a different amount, they're gonna question it, maybe push back. So short of knowing who to send that updated information to at every lender, so they can keep that approval updated and current, that's a tough one, unfortunately. And secondly, I will tell you, so across our entire footprint, we have like 400 plus DPA programs currently on our approved list. And each month I do a report and see how many we've used, what volume we're getting from them. We typically use about 80 of them, and that's it every year. And that's shame on us. So, how do we educate our loan officers to better use these programs too, I think is another thing that I've been scratching my head over for sure. So if any of you have any ideas on that, I am open for sure. I don't know if that helped you at all, but and like you said, other lenders might do it differently. I know I was talking to another lender and they say we approve the program for a year. After that year is done, we take it off our approved list. And if loan officers want to use it, then they go through the whole thing again. Well, that just is, to me, that's additional work. If it's approved, let's keep it on that list.
Thanks, Lisa.
You
Thanks,
bet.
Marnie. I think also too, I mean, that's one of the goal of standardization, right? So the more standardized some of these programs become, I think the less resistance we will see from loan officers and likely greater use of DPA programs, as well as make Lisa's job easier.
That's what it's all about.
Tanya, you had a question?
Yeah, thank you. We're working on our program, and we're going to be putting out an RFP to look for an administrator or administrators, potentially more than one. I was just curious if people would be willing to share kind of what they're paying or seeing for costs as far as administration goes, if they have other people doing it for them, and then just if there's any place that we should be making sure that we're reaching out to try to get a good number of people interested in potentially doing that for us. So I don't know if Megan has any input on how much they're, charging or being paid or any of that stuff. So
I think it varies widely, Tanya, but I can tell that what we have started to push is, this is going to sound like a really, really high number, but about 10% of the DPA. There's a couple of ways to look at it. When we've been having a lot of conversation about the fund reservation requires a greater administrative burden because you're going to have some home buyers who receive a approval and don't move to close because they can't find a home in their price range, etc. And so with that in mind, we still believe strongly that fund reservation is the way to go because it, all the things that were talked about, right? Like if you've got a guarantee letter or an approval letter when you're purchasing, the DPA is going to be seen less as a barrier. It gives people more confidence. It gives people more purchasing power, et cetera. So when you take that into account, I think we're looking to see that DPA funders properly provide the fee to many of the nonprofits that administer these DPA programs. And I think depending on who you're talking to, it's easily, I think, on the bottom end, $2,000 per transaction.
Yeah, I mean, I don't think that's out of the realm of what we were
Yeah.
thinking at all.
Yeah.
Just a follow-up question on the reservation stuff, because we've kind of done it both ways for other programs, and having people sort of tie up the money for a long period of time doesn't really work either, because then we're getting pressure from other people that are sitting there waiting. So I'm just curious if you can tell me kind of how long is that period of time that they have to go shop? Is it like a 6-month period of time, 3-month period of time?
Yeah, no, I think that's a great question. And actually the next meeting we're going to have is going to be in March, and we're going to focus solely on this fund reservation thing because we know that this is kind of newer, I think, for many DPA providers. But what we put in the standards, again, allowing, kind of even to your point, Stephanie, like allowing that each market is going to operate a little differently, right? So part of that is if you've got, $1 million, having someone hold money for a while may not be a big deal. If you're going to do 10 loans, having someone hold money for a long time is more challenging. And so what we looked at is a minimum of 60 days with the possibility of an extension. And we also, in the best practices, outline that someone should be pre-approved for a mortgage and have completed homebuyer education before you reserve the funds. And then at 60 days, if the home buyer is actively looking and searching and needs more time, then it would be, the discretion of the administrator to maybe extend that for a period of time. So it's a balance. It could tie up funds, and it's also more likely to result in a successful transaction. But as we know, depending on the market, it can take more than a month or two to find a home.
Yeah, but I think if you have kind of those steps already taken care of, I think that the trouble we had is like maybe reserving it before they had education done or before they had something else done. And I think you could tie those things together, that should help if there's stuff to buy in the market, I guess. So just to follow up on my other question, is there, like, as long as we got that information to, like, you at the Home Ownership Center, Brooke?
Yeah, we could totally
RFP,
share it
then
broadly.
like share it. Oh, okay.
Yep. I think there's kind of like a handful. There's probably 3 major players in the market right now who do this on a regular basis: CEE, NeighborWorks, Home Partners, and Build Wealth.
Yeah.
But I think there are others, and I think we could share it broadly. And I think a lot of funders use multiple administrators to make sure that they're reaching a broad swath of the community. So.
Well, we definitely plan to be as consistent with the best practices as possible. So I think.
Love to hear it, Tanya. Love to hear it.
All of it's stuff that makes sense to me, and has certainly been experiences and stuff that I've done with other programs. So it's not, shouldn't be that shocking to people to be wanting to sort of have some of these things that kind of float among all the populations and stuff. So thank you.
Great. All right. Other comments, questions, thoughts, concerns? Not everybody has to love this. We want to hear it all. Oh, Erin, come on.
I was just going to say, just to make a comment, as somebody who's been processing these loans for the city for a long time, I would just, if there's some way that it could become easier for the homeowner or home buyer, I feel like we have to pretty much collect everything but their blood to get them approved. And it is really hard sometimes, and it's a lot for the buyers. And then I know it's hard when you have federal funds, but having just a little flexibility, I so often see home buyers that are like $1,000, literally $1,000 over the income guideline, and then are unable to, access that down payment assistance. And those are usually the people that really do need it the most. So I didn't know if I should say that here, but if we could just make it a little bit easier for the home buyers to apply for these assistance funds and not have it so intimidating. That's all.
Thanks, Erin. I appreciate that comment. And it is the lens we want to continue to work through from, is like, what is going to be possible to do, but in the best interest of the consumer. And to your point, a lot of our down payment programs use household income. Sometimes that's a requirement by federal, sometimes it's not. And so when it's not a requirement of your funding source, what is the benefit of using borrower income? I mean, it's significant. It streamlines the process. It aligns with the first mortgage. You as a DPA provider have to do less. And then, your 20-year-old student who stopped home for 6 months on their way from college before they launch into life doesn't have to count their income towards the DPA when they're not going to be contributing to the mortgage or living in your home long term. So I think, we've got a long road ahead of us in terms of what do we do when funders can't align with best practices. But I think we've got a real opportunity to start where we do have flexibility. And we have more and more municipalities coming online with funds that are not tied to CDBG, that they're using other sources to allow the flexibility. And so I think now is a good time to have the conversation. And there's also a lot happening at the legislature and the potential of new DPA programs coming online. So being able to kind of establish this and say, this is why to do, let's not just do things because that's the way we've always done them. Let's do things that are in the best interest of the consumer and really align with having the biggest impact. And is not, DPA as an incentive, I think is important for some areas, but really we are focused on the DPA. That is, but for the DPA, a person would not enter homeownership. Other comments, pushback, concerns, thoughts?
Was there any conversation about, like, I know you guys talked a little bit about the income and kind of what you're including and not including, but also the like asset limit stuff. I mean, I don't think we're planning to put any kind of like you have to get rid of all your assets kind of thing before you buy. But I just was wondering if you were talking about that or talking about are there any best practices for the thought process that, like what we found in the study that we had Kira do, which is that they're scared to get into homeownership because in case something happens that first year and the furnace breaks down or whatever, was there any conversation about escrows or warranty programs or anything else like that potentially we could use the funding for, or that is tied into other people's programs at all?
We didn't go into that level of
Okay.
depth in terms of how, a DPA provider might be flexible to say, hey, you can use these funds for these types of things outside of principal closing costs. But I don't think there's anything that prevents you from broadening the definition of how you want to use the DPA. I will say the asset question, we opted for this first initial launch of the best practices to remain silent. We found this to be a pretty contentious issue, that there's lots of ways of looking at the asset in terms of there's some strong feelings about people have assets, they don't need the DPA. There's some strong feelings that people who have assets know how to maneuver assets to be eligible for DPA, like putting it in a short-term fund and then it doesn't count as a cash asset. And so I think the way that people are starting to go is to being a little bit more clear about what assets don't count, right? So retirement doesn't count, college education doesn't count, allowing a vehicle, if you've got 3 licensed drivers in the home, then you can allow 3 vehicles. So I think the trend is starting to go towards more fluidity and recognizing that we don't want to strip people of assets to get them into home ownership. But we did not, in the best practices, include an asset requirement or an asset maximum or limit. We thought maybe we'd tackle that in the future.
Thank you.
It looks like we've got a question in the chat from Sandy about home inspections. And we don't require this, and I'm not sure if I know of a DPA that does require home inspection. I think it's something that is strongly advocated for. You know, it's talked about heavily in homebuyer education, but it's not something, while we know is in the best interest of the consumer, it's not something that we have required. And essentially, if the first mortgage requires it, then it's required. So we would be deferring to whatever the first mortgage would require.
And I can, sorry, I was trying to get myself off of mute. I think Roxanne put a comment also answering that, but the home funds do require an inspection. But yes, in general, I see a lot of DPAs that do not require inspections, home inspections, and I approve them with the agency products, and they will allow it.
Yeah. Marnie, go ahead.
Not exactly a question, more of a comment. We started with our first generation program. There was a lot of concern because we were giving, depending on the income limits, it's a scaled program, up to $75,000 in down payment assistance. That was forgivable 5% a year for 20 years. And we had a lot of discussion around how are you ensuring that the people who really need that much funding are getting it. And so we talked about the assets, but then another piece that kind of came out of our housing authority board was we had originally had that they had to spend a specific percentage of their income on their, you know, principal, interest, etc.
Yeah, kind of a minimum housing ratio.
Yeah, and I mean, and I will say, we've only closed one first generation loan. So we closed that in the end of September. But prior to that one closing, we actually removed that. We were reserving funds, but what, you know, and really this is kind of CE was helping us. They're like, if you're really looking at this program from a wealth generation as well as down payment assistance, it was causing, you know, they said they implemented in other cities as well, but that it can be complicated because you need to know how much that house is to figure out how much and what their mortgage is in order to figure out how much down payment assistance they might be eligible. So instead of just knowing up front, like you said about that, a letter saying that they're eligible for this percentage of the purchase price, that is much clearer and can be, I think, you know, from their perspective, a lot more helpful to the buyer. And that putting this other layer in was really potentially harming their ability to purchase a home. And so because of, it wasn't just about buying a home, but this program is also about wealth generation. We did decide to remove that. And we didn't have that in our regular down payment assistance program. So it's like, well, why did we add it here? So anyway, just for us, it was, that was something that did simplify the program. And then also, I know that originally there was kind of a bit of pushback about reserving funds, but we, you know, we're like, nope, this is something we really want to do because we know that with the intention is that you said, like you said, but for these funds, they would not be able to buy a home. So if we aren't able to reserve funds up front on the first generation program, the home buyers wouldn't have been able to purchase the home. So anyway, those are some things. So, I mean, I think even, you know, like you said, these best practices are going to be changing. And I think for those of us who have programs, they're always changing because we're finding out like, oh, you know, this little piece doesn't work, or we set, you know, the dollar amounts or percentages at a time where now things have changed dramatically and we need to readjust. So I think for us, it's listening to, you know, what's working, and we've only had one close. Why? What's the barrier? What's preventing more from closing when our DPA program is at max capacity? So
yeah, thank you for sharing that, Marnie. I think it's just great input, and I think that you know, just to your point, like part of building this coalition is to continue to hear and learn from each other. Like we started with these best practices, we started with this smaller group. You know, this is a starting point and a launching point, and we think it's a really great starting point. But we are going to learn things. You know, I think many people would advocate for a minimum housing ratio because they're like, okay, you can't just pay 10% of your income. But to your point, that's not really what's happening. And instead it was just creating barriers. So how do we, well-intended things that we put in place when they're not working, how do we pivot? And so I think it's just a great example, Marnie, of you guys being flexible, and I appreciate you sharing that. Others? Anything else I'm missing in the chat? I don't think so. Hey, Rachel, nothing? Okay. All right. So I'm going to jump back to the PowerPoint here and close out our slides. All right. Okay. So all right, I just want to talk a little bit about adoption and endorsement of the standards. So, at this point, please jump in with questions as we kind of talk through these last two slides here. So essentially at this point, adoption is reserved for down payment assistance administrators that are committed to the best practices, right? Committed to implementing them and aligning their current programs and future programs with the best practices. We understand that this is going to take time. We know that many of the administrators, funders, actually, like to Roxanne's point, they have to go to like city council. People have to go to boards. People might be administering the programs and need to start conversations with funders about the opportunity for making some of these changes. So we know that it's going to take time. And so to start, really all we're saying is adoption is raising your hand to say, yes, I'm on board. And yes, I'm going to work to the best of my ability to get our program to align with these best practices. As we move forward, what we envision as this evolves is that over time, as programs start to meet the best practices, what we will do is raise up those programs. So right now on our webpage, Minneapolis, CPED, and others have committed as early adopters. But what we envision is eventually it will be their programs. We'll have DPA products and programs that meet the best practices listed and promoted. And that's what it will transition to over time. But we really know that this first year is going to be about socializing this, getting feedback, getting questions, and people working internally and with funders to try to make these changes. Any questions about that before I talk about endorsement? All right. So endorsement is reserved for key stakeholders in the homeownership industry. So we're looking at partners, major funders, foundations, lenders, realtor associations, and other associations. And essentially, endorsement is a way of demonstrating their support by showing their commitment to standardization and transparency in the best interest of the consumer. And then our hope is that endorsers will promote these best practices within their network and the broader industry. So we're kind of like at all angles, right? So like the DPA providers and funders will be talking about why standardization is helpful. And then we'll get the industry talking about why standardization is helpful. And again, begin to build this movement and give us a conversation as new funds come online of why to build your program this way, and really what is in the best interest of the consumer, rather than, to Marnie's point, probably having the best practices when they were building this program would have said, well, actually best practices say don't include a minimum. So like it gives leverage and it gives credibility to some of the conversations when you're dealing with decision makers who don't really understand this world, but met one person, had one experience, and then they want to build a rule off of that. They build rules off the exception and not what happens most of the time. So really looking for the opportunity for partners to think about endorsement and promoting these best practices broadly. And then I guess in terms of next steps, our ask is that you consider adoption, that you promote, not even if you're saying, look at this wonderful thing, but you're spreading the word about the best practices and these efforts to begin to kind of standardize and build transparency and coalition around this work. And that you participate and join us in some upcoming meetings. And if you have peers and colleagues that you feel like should have been here or known about this today, that you would spread the word and encourage them to participate in future conversations. We have created a web page just as like a starting point that's on the Minnesota Homeownership Center's website. And on this web page, which I'm going to go ahead and share with you now. Everyone can see that? Yes, yes. Okay, great. Essentially, it has a link to the best practice documents, which you can share with anyone. It's the implementation resources will be getting built out. So for example, this recording will be included on here. We're going to be doing a DPA on reservation funds in March, the meeting in March, and so you can register for that. And then as we record these meetings, we'll continue to keep these up, and then any kind of job aids that we create to help you make these changes. And then we also have more information on here about adopting and endorsing. So I probably should have been prepared to drop the link in the chat, but essentially you can find this, and maybe I guess I can do that now. You can find this on our webpage, the center's webpage, which is hlcmn.org under partners. I will go ahead and, oh, look at that, Rachel, my producer. All right, wonderful. So that's kind of all that we have. Is there any final thoughts or questions from the group? Okay. Well, I love to give people time back. So you can have some time on your schedule. I appreciate you guys coming and listening and learning. And, you know, again, this is a beginning. This is a start. So I hope that you guys will join us again in March for some continued conversation. Have a great day.